Welcome to another Advanced Options video. In this video, we'll be looking at the fifth characteristic that has to hold for a viable option pricing model. So what is the characteristic? What is the fifth characteristic? Well, it is that there must exist a convex relationship between the price of an option, which I'll call O, that reflects both calls and puts, between O and X. Don't forget, X is strike price. Okay, so there must exist a convex relationship. Must exist. Okay, what does that mean? What could that mean? Well, let's see. I guess graphically, what it means is if, make this a little straighter. Try that again, sorry. There we go. If we're looking at the relationship between call value and strike price, okay? If we're looking at that relationship, remember, if we're looking at that relationship, it means everything other than X that the call value is a function of is being assumed to have a constant unchanging value. And that's stock price, timed expiration, expected volatility of the underlying stock over the remainder of the option's life, and the appropriate risk-free rate of interest. Now, what is probably of most interest to us here now is stock price. So stock price is being held constant. So let's just say the stock price it's measured in dollars, so I can measure it on the horizontal axis. Let's say that is the stock price right there. At the current moment, these are strike prices. What this means is options that are down here, since these are call options that are in the money. You have the right to pay a lower price than the current stock price, S sub 0. And the strike prices up here are associated with options that are out of the money. If this S sub 0 is 30, then the right to pay, 45 is out of the money. Okay? So a convex relationship is illustrated with a curve that looks like this. Okay? In this case, it's negatively sloped. So we have a negative first derivative. And this is convex. Notice that the slope, as strike price gets bigger, in other words, as we move this way on the horizontal axis, the slope is becoming greater. Okay, not steeper, but rather greater. It's becoming less steep, less negative as X gets higher. Okay, and convex really means this. If I choose any 2 points, I'll choose this point and this point on that curve, and then I connect them with a straight line. I'll try to do this. Yeah. We're going to, oh, you know what? Let me undo that. I can use this kind of tool-like thing here. Watch this. Oh, pretty cool. You connect those 2 points with a straight line, and you notice that the line, the straight pink line, lies everywhere above our curved call value line, okay, with respect to the origin. So that is the graphical implication of convexity, okay? And so right there is, keep that in mind. Now, if we're looking at puts, let's look at puts for a moment. So I'll go like this. Okay, so we have put value as a function of strike price. Okay, and excuse me. And so this again is going to assume stock price is fixed at some value. Okay, say this right here. That's S is 0, the stock price right now. Okay. Well, that means in this case, since a put option's strike price is a right to sell, that means the puts with strike prices up here are in the money, and the puts with strike prices down here are out of the money. The right to sell at, say, 15 is, is out of the money if the stock price is currently S sub 0, which I guess is 30. Okay? And so that means we're going to have a convex curve that looks like this. Okay? Remember, on the horizontal axis, we have strike price. Okay? Now, once again, if we choose 2 points on this line, okay, any two, but I'll choose 2 that enable us to see it easily in the chart, and then I connect those 2 points with a straight line, okay, then we see that that line, with respect to the origin, lies everywhere above the put value curved line, okay? And again, that is convexity, okay? And so that's what's required, okay? So I'm just showing you graphically, that's what's required. By the way, just make note, the way I drew this down here, just understand this keeps going down. It doesn't loop up like that. That doesn't happen. As a matter of fact, let me get rid of that. There we go. Oh boy. Let's see if I can fix this. There we go. That's good enough. Okay, so now we've seen what convexity means. We understand the convex relationship has to exist between option value and strike price for both calls and puts. But what would we do if it didn't exist? Okay, so let's do this analysis now in depth. We'll just do it with respect to call options. Okay, so here is a 2-space. Sorry, it keeps sliding. I'm writing with this pen on glass, and it slides. And there we go. Then you have to hold it to make it go straight, but anyhow, that's good enough. Okay, so we have call value, and we have strike price down here. And we know that the curve looks like this. Okay, and we know that we've got this issue of convexity, and now I'm going to draw that nice straight line. Very good. And now I'm going to attach some values. There. So let's say this is a strike price, we'll say 20, and we'll say this is a strike price, we'll say 22, and then right in the middle is a strike price 21. Okay, this is a new stock, new example. Okay, and at issue now is what would be a fair equilibrium type price for this 21 strike call, given that we have this as the value of the call, which in equilibrium would be the market price, assuming our pricing model is good. Okay, so we've got these two prices here. This is the price of the 20 strike call. This is the price of the 22 strike call. At issue is what's a fair price for the 21 strike call. Now you can kind of tell on the curve it's going to be this value right there. Okay, but we want to think about two other situations. The first is, what if the price of that call, instead of being this red dot right there, what if it is, I'll put it right on that straight line. What if it's that? Okay? And then another case we're going to look at in a bit is, what if it's even higher than that? Okay? But we're going to look at those in a moment. Not right now. We'll just look at we'll look at the first one, I guess, right now. So, all right. So, well, since this red line is a straight line, we know that the value for that green would lie right there, and it would bisect this segment here and here. Okay? And we also know that the 21 strike, which is right in the middle of 20 and 22, would have this point associated with it. It just makes sense. And I guess it's not really drawn well to scale, but this distance from here to here is the same as that distance from there to there. It's not, my artistic abilities, as you well know, are far from perfect, but they would have to be equidistant, this and this, okay? But, you know, just keep that in mind. All right, so, well, let's put some value. Let's say this is $200. We'll do this in blue, I guess. Let's say this is on a per share basis, $2, and let's say on a per share basis this is $3.20, and then the straight line, the green dot here, which is in the middle, would have to be right in the middle between $2 and $3.20. That's a distance of $1.20, so you add 60, so it'd have to be right here at $2.60. Okay. And what we're saying is that is not a viable price for the 21 strike call, given the price of the 20 and 22 strike calls. That's not a long-run equilibrium sustainable price. Okay? Now let's see why. Why is that so? Well, here's why. It's actually quite interesting. So what we can do is we can go long one call with a strike price of 20. We can go short two calls with a strike price of 21. And we can go long one call with a strike price of 22. Okay, given that these are the prices, which we know are not equilibrium prices. Okay, so let's look at this. So when we do this, we're going to buy the 20, so we're going to spend $200 for the contract. We're going to go short two 21 strikes, and that's going to give us 2 times 260, or $520. And then we're going to buy one 22 strike, and that's going to cost us, the 20 strike call, I put the wrong number for the 20 strike call. Okay, the 20 strike call is going to cost us $320. I'm sorry. And then now back down here, when we buy the call with a strike price of 22, it's going to cost us $200. Okay, and of course when you add this up, we have this and this is negative 520. It's cost us nothing. Okay, and you might recognize this. This position is something that you've seen before, and I'll kind of get you to think about that as I talk through this, and I'll tell you later. Well, this is interesting because this position that we've taken here costs us nothing. Well, that, we might say, well, it costs us nothing. Is it ever worth anything? Well, let's see. Let's look at some prices that could exist at option expiration. So let's look at various values for stock price at option expiration. We'll look at 19, 20, 21, 22, 23. Yeah, that's pretty good. We'll look at those. And then we're going to look at the value of our positions just a moment prior. So I'll say maybe 1 minute prior to OE. Why is that? Well, that gives us time to close our position if we want to. If we hold our positions through the moment of option expiration, which for most stocks is 4 o'clock on Friday Eastern Time, 1 o'clock Pacific Time, then we're stuck with exercise or assignment, whatever happens. Okay, so, and here's my long call with an exercise price of 20. Here I'm short 2 calls, exercise price 21, and I'm long 1 call, exercise price 22. And now let's just look and see their values. Well, if the stock price is 19, this is kind of easy. All of these options expire worthless. The right to pay 20, 21, and 22 all expire worthless if the stock price near OE is, or at OE is 19. Even though we're short these, I can still make that statement about the 21 strike call. So these are all worth nothing. And then my credit, well, was nothing when I set it up. So I'll put my I'll call it a credit even though it's 0. Credit 0. And then my profit, if stock price is 19 at OE, is 0. Okay, let's look at 20. Well, 20 is going to be the same because all that happens is this option is at the money. At the money options expire worthless. So again, we've got all these zeros, and then there's a 0 there for the total. Okay, what if stock price is 21? Well, I'm long this call with a strike price of 20. Its intrinsic value for the contract at option expiration will be 100. So I'll sell it and I'll get it. We're ignoring bid-ask spread. We're ignoring commissions. The 221 strike calls are at the money. They expire worthless. So there's no cash outlay required to buy to close those 21 strike calls. And, of course, the 22 strike call that I own expires worthless. Credit's still 0. I'll make $100. Okay, that's pretty good. What about stock price? A stock price of 22 at option expiration. Well, the 20 strike call that I'm long is worth 200. A 21 strike call would be worth, if I don't own it, but whoever owns it, if the stock price is 22 at OE and you have the right to pay 21, it's worth $100. And there's 2 of them, so that's $200, and I'm short them, so I have to buy to close. So that's $200 I have to pay to buy to close. My 22 strike call is at the money. That's worth nothing. Credit's nothing. I'm back to nothing. What about the circumstance when the stock price is 23 at option expiration or right by option expiration? Well, my long 20 strike call is going to be worth 300. Each of the 21 strike calls that I'm short is now worth $200 each, and I got to pay, therefore, $400 to buy to close, and that's minus $400. But my 22 strike call that I own is now worth, because the stock price is 23 by assumption, is worth $100. So again, put my 0 there for the credit. I should put it in quotes because it's not really a credit. And I'm back to 0. And interesting. By the way, if this price goes to 100, I'm still going to be 0. And if this price goes down to 0, I'm still going to be 0. So, and by the way, just interestingly, let's take a peek here. I'll change the color to purple. Let's put $20.50 there. You can see this call is going to be worth 50. And this is 0, 0, 0, and therefore the whole thing's 50. And then I'm also now going to put 21.50 in there. You'll see why I do this in a second. And that means this one's going to be worth 150. At 2150, each of these calls is worth, if the stock price is 2150 at OE, each of the 21 strike calls has a market price of 50. I have to buy to close 2 of them, so that's going to cost me $100. Okay, 22 strikes still worthless at OE. Credit's still 0. And when you add this up, you got 50. This just helps you see we got a bunch of zeros, like a bunch of zeros, a 50, and then 100, and then a 50, and then back to the 0. And you see that and say, oh, yeah, that's quite familiar. And that is, of course, the profit diagram. I won't get too specific, known as a butterfly, right? Specifically, since we made this out of all calls, this is a long butterfly. Okay, this is a long butterfly. All right, so let me just put that in a profit diagram for you. So, okay, so here we have profit on the vertical axis, stock price at OE, at, you realize, maybe a minute before. And here we had, here's 21, and you know the other ones. So what we really have then, I'll draw this in, I'll draw it in, I guess, red. Okay, and remember, there's 100. And that means here at 20 is the 50. Here at 2150 is the other 50, and then these are zeros. So this is our profit diagram. Okay. What's amazing about this is we never lose. Okay. There's no way here where we lose money. We break even at these stock prices at option expiration. We break even at those stock prices. And for stock prices between here and here, we win. Okay? $1, $2, $50, 51, 52, 100, 99, 98, 50, 25, 1, 0. And so that's what we have. So, and the point is now to be made. Please pay attention. People would do this all day long. Remember, this cost us nothing to set this up, right? And we can either not make anything or make money. And that's a deal people would take all day long. People would take that deal all day long. Now, how do good markets work? Because this is not equilibrium. How do good markets work? Well, once again, the trades being taken by the wannabe arbitrageurs end up pushing prices in the direction prices need to get pushed in so that this arbitrage opportunity, that is this disequilibrium, disappears. We're buying the 20 straight call, therefore we're bidding up its price. We're selling the 21 straight calls, therefore we're driving down their prices. We're buying the 22 straight call, therefore bidding up its price. So that means we got a minus sign here, and then this number here is going to get bigger, right? This number is going to get bigger, so it's a bigger negative number as additional trades go on. Once again, here we get a negative sign because we're buying it, and then we're bidding up its price, so this number here is going to get bigger, and we're selling the 21 straight calls, so we get a cash inflow, and the price is falling, so this number is going to get smaller. Well, if you think about it, if this number gets smaller and these gets bigger, this number right here will become negative. Will become negative, right? Which is the normal case for the net cash flow associated with initiating a long butterfly. Okay, having it be 0 was not consistent with a normal equilibrium pricing scenario for a long butterfly. Okay, so interestingly enough, the way good markets work is that whenever prices are out of equilibrium, the trading behavior of the arbitrageurs pushes prices back to a new sustainable set of prices, and a new equilibrium relationship between those prices develops. Okay, so that was interesting. Now, but I guess technically what that just shows is that it can't be on the line. By the way, you can now see that if the price, and this is an important point, I'll make the point right now, you can now see that if the price is right here where it's supposed to be, that value is right there, which is less than 260. We already know that 320 on a per share basis, well, I'll do it on a per contract basis. Okay, we already know that 320 with a minus sign and 200 with a minus sign, and then 260 times 2 is 520 is 0. So common sense, or just by observation, we can see that if this price in the middle, 260, is lower, then this number is going to be something less than 500. I'll just choose another number, 480. Okay, and if that's 480 instead of 520, then we are down here to a minus 40 cash flow, which means that we had to pay a net $40 to take a position in the long butterfly. Okay, so we can see right now that yes, if we're on this this convex line, we are going to satisfy the requirement for prices such that this long butterfly will not be profitable or break even for us. Okay, so what I've just shown you now is that this is right. It's great. Okay, let's look at one more case though. Let's now look at a case where the actual price is right there, higher than that straight line price. This one's actually quite interesting. So I'll go over here, and let's just pretend that value there is, make it interesting. Let's just say $3. Okay, so make that $3. So $3 is this price right here, and that price right there associated with the 21 straight call. Oh, well, interestingly enough, if that's $3, that means when we write that I'll just make the adjustments here in another color. I'll make the adjustments in black. Okay, so in other words, when we set up our positions here, okay, the minus 320 stays the same, so that stays the same. The minus 200 stays the same, but this 520 then becomes, well, we're assuming it's $3 times 2 is $600. So this becomes $600. Oh, okay. And when that's $600, we have 600 positive and then a total of 520 negative. This becomes $80. Oh, now that's very interesting. Well, what that does for us is it changes this row right here, right? Changes that row right there. Now we go here and all of our credits become 80. Okay. And therefore every value down here in profit changes upward by $80. So now our profit is 80, 80, 130, 180, 130, 80, and 80. Okay, I'll put little delineators here to hopefully make this. Okay, this was the 21, just so we're clear on this. Oh, no, it wasn't. No, I'm sorry. That was the 2050. Let me just correct that. Okay, so, yeah. There we go. And then here, the 21 is our 180. And the 2150 is our 130 again, and 22 is 80, and 23 is 80. Okay, so spend some time looking at that and thinking about that. It's pretty interesting. And now, well, you're probably already ahead of me. If I draw the profit diagram for this now, okay, I'm going to have the same shape, this same shape. It's just that my low point is going to be right there at 80. And so we're going to have this diagram. And what's interesting, this is our 21 and so on. And what's interesting about this profit diagram, let me see if I can do that a little more neatly than that, and in a different color. So first thing I want to do is go here and erase this. And then I'll go to a different color, red. Now I'll go. There we go. That's better. And now that's pretty interesting. This profit diagram here is like, wow. You do that all day long, right? Why? Well, because you never lose. You either make $80 or you make $180 or something in between, right? And so you do that all day long. And so the way we arbitrage, well, first of all, what we're talking about is this point right here. And that would kind of imply what? Well, I'll put a line like this. That would imply concavity, right? The first red line right here was a linear relationship, right? This right here is linear relationship. This new line is a concave relationship, and the one that works on the blue line, of course, is the convex relationship. That's the one that's this one right here is the one that we'll see in equilibrium in the real world. But now we've got a situation where it's concavity, and boy, you'd love to see that, because then you can set up something like this where you never lose. Now, what happens? Well, again, when you start making your trades, you're buying this, so you're bidding up. Oops, no idea what I just did. Okay, so when we're buying the 20 strike call, we're bidding up its price. When we're buying the 21, when we're selling the 221 strike calls, driving down their price. Buying the 22 strike call, driving up its price, same thing again. This price rises, this value falls, and eventually this 80 becomes negative again. And it needs to be negative. Because if it's negative, it means it's not a riskless position, okay? This profit diagram is riskless. This profit diagram, this one's riskless, and this one down here is also riskless. And you can't have riskless circumstances associated with a long-term equilibrium set of prices. So, I think that makes it clear, and we went in depth on this one with the calls. The analysis for the puts is analogous to this. You might want to try that on your own for fun, but I think it's quite clear that you're going to get the same result. And again, what is that result? Well, I'll draw a new picture. The result is that when we're looking at the relationship between, I'll say, call price and strike price, okay, that there must be a convex relationship between their prices. Okay, between their values, call value and strike prices, in order for an equilibrium to exist. Now, that's what we've shown, and I've given you the proof for all that. Now, here's something that's actually quite interesting also. Recognize that if I'm just now going to put a bunch of strike prices to make this point it's kind of interesting. I'll just make up some numbers, 15, 16. Okay, so there's some strike prices. Now, what we just saw this working for strike prices 20, 21, and 22, right? So we just saw that this has to hold for, for these three prices here, okay? But I want you to realize, I'm going to add 25 and 26 in just for fun. So we just saw it has to hold for these three. But I want you to realize I'll put this in a different color. It also has to hold for the 21, the 19, and the 23. And another different color. And it also has to hold for the 20, the 19, and the 18. And it has to hold for the 20, the 18, and the 16. Okay? So, and one more to really drive the point home. Green. And it also has to hold for the, to put it over here, the 21, the 25, and the 17. Because as long as we're heading one distance in this direction and that same distance in the other direction, then this convexity between the prices of the calls has to exist. So again, it's not just the three we talked about. It's much more complex than that. So that is the fifth characteristic that must exist for a valid option pricing model. And that's all I have for this video. Thank you for watching.